Hello and welcome to Switzer Investing TV. I'm Peter Switzer. Thanks for joining us. I'm a bit casual today. I'm in Thredbo in Snowland, working on Zoom, and it's not all that strong, so it's going to be a quickie today. But I have nailed Adam Dawes of Shaw and Partners to look at the 5 stocks he thinks look really good for this financial year coming up. And then I've also asked him about when he thinks electric vehicles will start, being in high demand and lithium prices will take up. There's a range of other questions that you might be interested in. So let's go and kick it off with Adam Dawes of Shaw and Partners. Thanks for coming on the program, Adam.
Yeah, it's great to be here, Peter. Thanks so much.
Okay, so I've set you a little task. I'd like to talk to you about what you think might be the best 5 stocks for this financial year coming up. So let's kick off with your number one.
Yeah, look, Technology One. It's an ASX 100 or top 100 stock. It's in the technology space, but this company designs, develops, and installs large enterprise businesses within sort of large to medium software or large corporate divisions. Its key strength is certainly where its software is at the moment, and it is very boring as such because it's got some very large contracts with governments and those kinds of things. But their software as a service is actually doing quite well. So T&E is the stock code for everyone playing at home. And I think that one is certainly one of the number one picks in the technology space.
Yeah. Has it been under pressure lately, or has it been on a rising trend?
It's actually been under a little bit of pressure or sort of moving sideways at the moment because of its sort of valuation. But tech stocks and tech valuations, look, they move a lot higher than regular. So I'm okay with that. And it certainly has a lot of legway or room to move to the upside.
Okay. Let's get your second one now.
Yeah, so my second one is in the diversified financial space, and it's in with Perpetual. I know this one sounds a little bit different, but certainly Perpetual is one of those ones that looks really good. They're certainly looking to dispose of their corporate trust side of things and their wealth management divisions, which really sort of cleans itself up, which means shareholders potentially might get a capital return or they might offer a higher dividend. Plus, then it cleans their business up. Potentially, if there's someone that wants to take it over, Perpetual is certainly one of those ones that looks very, very good. But look, the whole idea of those expectations that Perpetual will continue to do well, and I think that one does look quite good going forward.
Is it that they want to concentrate on funds management more than anything?
Yeah, so they're selling the corporate and the wealth management side to KKR. So that's a private equity business. Just be careful, everybody, because they're going to try and wrap that back up and put it back to the market at a higher multiple. So we need to be a little bit careful there. But really, the whole idea is that, yes, they're going to concentrate on funds management, and that's their sort of core business, which they've done very, very well. Although that corporate trustee business is absolutely fantastic, one of the best in Australia. So, I think KKR is getting a pretty good deal. But Perpetual will look pretty good once it's all been cut down or right-sized, and it's not a bad one to look at for the new financial year.
Okay, let's go number 3 now.
Well, number 3 is a little bit interesting, but it's Premier Investments, Solomon Lew. And now he's obviously taken a little bit of a play to look at Myer, and he's a bit of an agitator there. But Premier Investments, if it does happen, Premier Investments is going to sell Just Jeans, Dotty, and a couple of other businesses to Myer. Myer's then going to get access to those integrated, to those lines of businesses, but which means Premier Investment clients are going to get access to some Myer shares via a scrip, or you're going to potentially then also look at something like Solomon Lew's going to be on the board of Myer as well. I think Premier Investments, it's in the discretionary retail side, but it's a very, very good business and very, very well run, disciplined business, and that's what you want in retail side of things. So I think Premier Investments is actually quite a good choice for investors at this time.
And also, Solomon Lew has been trying to get control of Myer for a long time, and I guess his very performance with Premier shows that he probably is the person who could best lead Myer.
Yeah, definitely. And Myer wants him inside the organization instead of outside throwing bombs in and trying to do stuff. They want him inside to help work for the business. And the new CEO was the old director of Qantas Frequent Flyer Points. Now, remember, Myer One, there's 4.1 million Myer One card holders out there with loyalty points in there as well. So again, there's some really good synergies that are about to happen in that discretionary retail space.
Okay. Number 4.
So number 4 is IPD Group, which is IPG, is the stock code, IPG. Basically, it's electrification of all things. Electrification basically being a dominant market provider. These guys do electronic car, electronic vehicle station charges. They're doing a lot of stuff to do with data centers and electrification of data centers and owning the end-to-end supply of that one. This has been a fantastic one. 2025 shaping up to be a really good year for these guys. The stock has moved sideways a little bit, so it's going to provide an opportunity for us to get in, but there are earnings upgrades, or it is in an earnings upgrade cycle, and I think that one would look really good inside clients' portfolios going forward.
Yeah, and we know that if EVs, electric vehicles, are going to work, they need the infrastructure. So they are in the right space, aren't they?
Yeah, correct. And there has been some stuff around Tesla, lots of cars sitting on the lots, all those kinds of things. I think people are going to move through that. I think that's going to happen. There's always going to be a bit of a lull, but as that starts to happen, I think the world is moving towards electronic cars, albeit the hybrids are there, albeit that I think the electronic cars, and we need the infrastructure for that to happen. So the government needs to step in, and IPD or IPG. All right, so ready for the last one?
Exactly. Number 5.
All right, so I've got 2 in the last one because they're both in the energy space and they're both in the uranium space.
Yeah.
Okay. Paladin is one that I really like at this level, and Boss Energy are the 2 that I really like in that space. Boss Energy has come under a fair bit of pressure of late, so you need to be mindful that in the last 6 months, the business has changed a little bit, and I think overall they're going to do very well. And Paladin, number 1 producer now in Australia for uranium. I think everybody should have some kind of uranium exposure to their portfolios, albeit Australia is talking about, uranium as being a part of the clean energy. I certainly think that's going to happen, and that's something that I think that we all should be taking advantage of. And Boss and Paladin are my last 2. So there's a bonus one there for everybody. But the uranium space is somewhere we should definitely be positioning our portfolios for.
Yeah. And again, online is just these companies export uranium as well. So we don't have to wait for Australia to change its politics. There are plenty of countries out there are becoming increasingly supportive of the idea of using nuclear. Mate, I also threw a question to you, the house view on when electric vehicles demand will help lithium prices, because lithium share prices are really good levels. They're heavily shorted on the stock market by the short sellers. But what kind of timeline do you guys have before we start seeing lithium prices react to better demand for electric vehicles?
Yeah, there's no doubt about it. We're in the wrong part of the cycle of the lithium price. And we all know that if the commodity price is lower, the share prices will follow. Again, on the other side of that, if commodity prices are starting to go up, share prices will move with that. And at the moment, we're seeing that commodity price, lithium price, being quite low, and it's part of the wrong end of the cycle. Now, if you're a contrarian investor, that wrong end of the cycle is probably now when you want to start to be looking at those kinds of things. And the problem is that we've got a lot of Chinese companies that are coming in and flooding the market with lower grade lithium to then keep the price down. And that's what what we're seeing at the moment. But you've got a lot of marginal producers. These producers are that if they can't make a ton of lithium at the commodity price where they are, you shouldn't be investing in them. And so there's the likes of CXO, those kinds of things where they're basically, they're all on care and maintenance. Their mines are basically shut down. They've got 80 million sitting in cash in the bank, but they can't do anything with that because the lithium price is too low for them to make a ton of lithium, just like iron ore, copper, and everything else as well. So you want to be careful about that. I think the lithium demand is going to still be there. We still have, it's not just a Tesla battery, it's a house battery, it's a mobile phone battery, it's all these batteries that we see. And I think that lithium story is going to turn, but you just have to have some patience and you have to be careful because there are some shorters in some of the stocks in those lithium plays.
So the house view on the favorite lithium play?
So yeah, I've got two, which is IGO. Greenbushes is an amazing project, and I think that would definitely look. I mean, it looks like it's on its knees at the moment. I'm down 50% on from some of my clients, but I'm happy to hold. And then PLS, which again we were sort of buying at sort of 3s and 4s. It's now at 2s, 3s. I think we've got to be a little bit careful there. But again, they got a lot of cash sitting in the bank, and they will be able to ride out this storm. And I think they're my two picks: IGO and PLS in the lithium space.
Okay, next question. Do you guys get influenced by the short sellers and the stocks are shorter? Does it make you afraid to buy them, or does it give you an opportunity for when they eventually get caught in a short squeeze and the share price spikes?
Yeah, so I mean, obviously PLS is one of those ones we've been talking about for 6 months. It's got over 23% of its share register in shorters hands. And that's been playing in the shorters hands because the stock has, fallen $1 over the last sort of 3 months. So that is helping the shorters move forward. I think it's something that you need to be mindful of. I think anything over sort of 10% to 15%, you need to be worried, or you need to be mindful of what's happening in the share price, as well as what the shorters are happening. But pretty much from there, anything that's 2 or 3% shorters or 10% shorting, I'm actually okay with that. I think it provides a bit of liquidity. It provides that. And if something like PLS and the shorters need to cover, this stock will be a $4, $5 stock all day long. So hopefully we can get rid of some of those shorters in some of those stocks. But it's a tough one. And I'd probably be mindful if it's over 10 to 15, 20% of the register, then you got to be careful. Anything under that, I'm comfortable with that as making an investment in a share.
Okay, last one, mate. How can a client put a stop in place with a stockbroker like you guys?
Yeah, so first of all, stops need to be done on the downside as well as the upside. Okay, so that's the first thing. You need to be mindful of that. If you're making a stop or a stop out, on the downside would generally be around 10, 20%. And you just either tell your broker, or if your online provider provides you a stop loss limit. So in other words, it will move up and down on a 10% variance or 12%, 15% variance. But that's on the downside. But also then on the upside, you want to do a stop loss of 50% on the upside. If your stock is then, if you're going to run stop losses on stops, on losses or profits, then on the upside, you want to also be running that at a 50% upside. So if the stock rallies by 50%, you're out as well. But basically telling your broker that you want a certain price limit, or then there are facilities then to running stop losses on your stocks, where that if it falls by 10% in a day, you're out. That's the kind of thing that you want to be able to do.
Yeah, but I guess the bottom line is that people can request a stop, but sometimes it might be impossible for you to get them out unless it's at a ridiculously low price.
Yeah, so sometimes it sort of whipsaws. It'll go down and hit those stop losses, and you can see them in the market. They hit the stop losses, and it continue going down until there's no more stop losses, and then the stock rebounds. The thing is, I think you just got to be mindful of how much of a trading limit you want to put on these things, so that you don't get that whipsaw and then you go, oh, I didn't want to get out, and the stock's higher. But because you put those rules in place, you got to be a little bit careful. But speaking to your broker or doing it online, I think it's certainly the way to go to protect the downside as well as the upside to your portfolio.
Now, one related question: can you put a stop loss on an ETF?
I actually don't know. I would say yes, because it's traded like an equity, so you should be able to do it. But I'm not too sure. I'd have to come back to you on that one, Pete.
There'll be homework for next fortnight, mate.
Done.
Cheers, mate. Thanks for joining us very much.
It's great to be here.
That's Dawes of Shaw and Partners. That's the show for this week. Thanks for joining us. We'll see you next week.